Hello, everyone. Greg Towner here with Parallel Portfolios, and it is time for our April 5 charts in 5 minutes. So let's jump right into it here. We, of course, like to start off looking at the S&P 500 over the last few years. And what's transpired as we record this Tuesday afternoon is the markets have surged back almost to a new high. It's amazing. The market used to talk about how it took the stairs up and the escalator down, but these days it seems like with any past correction that we've had, it just takes the fast elevator back up higher as people come in to buy the dip. So market is back almost to new highs, at least for the moment. We'll see what transpires as we go forward. But of course, what's been the big driver of things is oil. As we look back here, oil had been declining in price for a couple of years, and it settled in and maybe in the $60 to $65 range before the war started in Iran. It surged, of course, to almost hit $120 on a couple of occasions over the last month or so. As we record, it's back to around $90, $91, come off its highs. But what's been interesting is the way that commodities like oil are priced. It's not just one price. There's different futures contracts over different time periods. And the what's called the front month contract are the ones that we're looking at here that got almost to $120. But the other contracts looking out into the summer and certainly into next fall never got anywhere near that high. So in other words, investors were just making the bet, the assumption that oil and this whole event in the Middle East would be short-lived and that oil would not stay up there that high for that long. And at the moment, it's looking like things are moving in that direction. But of course, every time you turn around, there's some new news that's happening, negotiations or otherwise. So we'll see. But the market expects prices to be lower as we look out a few months. Well, sticking with the oil theme here, I thought this was a really interesting chart. This white line is the oil chart we just looked at, but a little bit longer time frame. Whereas the red line is what's called the oil and gas rig count. So in other words, how many actual wells out there in the United States are being drilled. You can see historically that when oil goes up in price, a lot of new rigs come on. Oil producers are like, oh, we have a great opportunity to make more money now. We're going to produce a lot more. Well, then that helps cause the decline in price because it's just more supply coming on. What's interesting is this time they did not bring on, or at least not yet, have not brought on all the new rigs as oil price moved higher. So I think there's a couple of reasons for this. Number one, over the last few years, investors have really pressured these oil companies to not bring on all the new rigs when oil goes higher. They want them to focus more on cash flow, and that's what they've done. But I think also they're just like I said on the last slide, looking at, hey, maybe oil won't stay this high for that long. So we're not going to go spend a bunch of money bringing on new wells. We're just going to produce what we can at this point, make some good cash, and see what oil does in the months ahead. So beyond the oil market, what we've seen and a couple other positives for investors that have helped move this market higher. This is a longer term chart of the PE, price to earnings valuation over the last 20 years. The orange is that valuation for the S&P, and the green is for the technology sector. And you can see here that they've really pulled back off their highs to not historically low level by any stretch, but more historical normal levels with that market correction. Now, this chart is a few weeks old now, so these have moved back up some. But importantly, they've probably not moved back up to their ultimate high where they were because part of that equation, PE, the earnings are looking really strong right now as we look out over the next year. Each one of these lines represents the estimates for each quarter this year. We just finished the blue the first quarter. But if analysts are correct over the remainder of the year, they're expecting earnings to increase somewhere approaching 20%. I mean, that number just on the surface sounds high, but if they are even in the ballpark of that, that's a real tailwind for stocks and for the market. And part of the reason that investors are looking past the oil price right now. So in closing, markets tend to look past trouble, right? So whether it's the economy is in a bad spot or there's some sort of crisis going on, when things look and feel the worst, that's when the market starts to look forward and starts to increase prices when people don't feel like it should be doing. And so that's what it did again this time. And keep in mind, markets tend to go up over time. So it just pays to be more bullish and not to focus on all the negatives all the time. Well, that being said, though, we still think there's potential for volatility ahead. And so we are keeping a modest amount of cash in many of our strategies because we view cash as an asset, and we think that there could be opportunities to deploy it when better prices come along or just new ideas come along. So not a huge amount of cash, but a little bit in some of the portfolios should volatility continue. So thank you for joining us. If you have any questions, obviously always reach out and we'd be happy to help you. Thank you.